So, is Wolfspeed a phoenix rising from the ashes, or maybe just a quick firework? I mean, this company just went through a huge corporate rebirth, and its stock chart lately looks less like a gentle slope and more like an EKG after maybe a triple espresso. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today we're doing a deep dive into Wolfspeed, that's ticker WOLF. We're going to dissect this dramatic corporate turnaround and the frankly, explosive stock move using data pulled on September 30th, 2025.
Yeah, it's been something to watch. When we put out our research just a few days back, we were actually bearish. But we specifically called out two big risks that could flip that view. One was a positive market reaction to their whole reorganization plan.
Yeah.
The other was the really high short interest.
Yeah.
And well, looking at our latest research, both of those things happened big time, which explains the volatility we're seeing now.
Okay, let's dig into that. The wider market picture is a bit confusing, right? Kind of a split personality. Q2 GDP got revised up, strong number, 3.8%, suggests things are humming along. But then you see other signals like heavy truck sales pointing towards a slowdown. That kind of mix usually makes investors pretty nervous.
Right, but what's really fascinating here is how the Wolfspeed specific news just completely steamrolled that macro uncertainty. They officially emerged from Chapter 11 bankruptcy. And this wasn't your typical distressed situation. It felt more like a planned strategic reset. They managed to shed, about 70% of their total debt?
70%. Wow.
Yeah, huge. And critically, they swapped out all the old shares, completely new equity structure.
That's the real key, isn't it? Basically hitting reset on the balance sheet, a clean slate, and the market clearly loved it. The stock surged. What was the number? An eye-watering 1,700%, closed at $22.10 that day.
Yeah, just incredible. And it wasn't only financial engineering, This whole rebirth lined up perfectly with them releasing their new 200-millimeter silicon carbide wafers.
Ah, the sick tech.
Exactly. That stuff is absolutely vital for next-gen power electronics. Think high-efficiency electric vehicles, faster charging stations, that sort of thing. It gives them real structural importance moving forward, which helps justify some of that optimism.
Okay, so that sounds like a perfect setup. Clean balance sheet, future-proof product. But Wall Street seems totally split. You've got one analyst pounding the table with a strong buy, but then fully half, 50%, of the analysts covering it are still slapping a strong sell rating on it. Wait, how? If the fundamentals are reset and the product's essential, why are half the experts still so negative? What are they seeing?
Well, that huge divide isn't just academic chatter, right? That's what created the tension, the fuel for this move. That skepticism is the fuel. Our data shows the short interest. It's just staggering. It was sitting at over 50% of the company's float.
50%? So more than half the tradable shares were betting against the company.
Pretty much, yeah. Meaning folks borrowed those shares hoping to sell high and buy back lower. A massive bet against the stock.
Wow, talk about a coiled spring. And you add the options market on top of that. The ratio was, 2.68 bearish puts for every bullish call, heavily skewed negative?
Exactly. So that enormous short position became the engine. When the stock broke out after the bankruptcy news, all those shorts had to scramble, buying back shares to cover their positions, pushing the price even higher, a classic squeeze.
Looking at the chart, you called it explosive. It really was like a volcanic eruption, wasn't it? A violent 180-degree turn in the short-term trend, and the volume, just immense, a financial stampede.
It was. But, and this is the crucial caution now, that kind of velocity isn't usually sustainable. Nearly every momentum indicator we track is screaming extremely overbought. It's gone so far so fast. A cool down, maybe even a sharp pullback, seems almost inevitable just based on the technicals.
Okay, so putting it all together, fundamentals reset, hot product, but crazy short interest and now technically way overbought. What's the takeaway for, someone watching this right now? What's the strategic outlook?
So our strategic outlook, despite those flashing technical warnings, is actually cautiously bullish. It's cautious, yes, but bullish.
Interesting. Why bullish after that overbought warning?
Because the fundamental catalyst emerging from bankruptcy, clean, shedding debt, launching that key SOAR product, feels like a really powerful structural change. We think that overrides the short-term froth and the negative sentiment, at least for now. But there are key levels to watch. For this bullish case to stay intact, the stock really needs to build a base, find support above that $25 mark in the coming sessions.
Okay, $25 is the support zone.
Right. And the critical invalidation level, the point where you'd say, okay, the squeeze failed, the bears are right, is a decisive break back below $22.10. That was the breakout closing price. Falling back below that would be a very negative sign.
Got it. So support above $25, danger below $22.10. It really highlights that we shouldn't confuse a rocket launch with achieving a stable orbit, right? This looks like a name for traders who understand and respect that kind of volatility, but backed, maybe, by a genuine turnaround story. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.